Hello traders, this is Fawad Razakzada, market analyst for City Index. Today is the 17th of June. So the markets remain firmly focused on the oil market given the situation in the Middle East, and that's keeping oil prices supported because of concerns about disruptions to supply. Now oil prices have bounced back after yesterday's sell-off, finding support at a major support area between 70 to 70.50, this blue shaded area, which was the breakout point really where the rally that started on Friday kind of commenced from that zone, and that level was tested and we bounced from there, and now prices have risen to near $75 level once again. This is the WTI chart. If I zoom out to the daily time frame, you can see that prices are also above the 200-day moving average, but coming up to test resistance here at around 75, which is going to be an important level. And if we can break above that area, then we could potentially be talking about last week's highs and possibly 80 and beyond should the situation deteriorate there. Now the oil price gains have caused equity indices, as you can see on the watch list on the right hand side, to drop across the board, and the European markets are down sharply as we head to the close. On Wall Street, the major indices are also lower, but not to the same extent as the European ones because of expectations that the US may stay out of the conflict, and therefore it might not impact the US markets as much. In any case, the prior bullish sentiment has taken a hit because of geopolitical concerns and because of concerns that the US is struggling to strike trade deals with its major trading partners. And for that reason, we've seen the indices lose the prior bullish momentum that they had built after staging a major rally off their April lows. Now looking at the Dow Jones here, the benchmark stock index is turning into a bit of resistance here at the 200-day moving average, which it took out on Friday following that big drop. It did bounce on Monday, but notice that it closed just below the 200-day moving average, and this level is being tested today at the time of recording, and it's holding the market down so far. So the 200-day moving average and Thursday's low coming in at around 42,560 is the first major area of resistance, which is being tested. Above that, we have the prior high that was created at the end of March before the reciprocal tariffs announcement caused the markets to tank. So that high was tested on a couple of occasions before we finally broke above it on Wednesday of last week. However, as you can see by the shape of the candle from Wednesday, we didn't post a decisive close above it. Instead, the market created this doji looking candle, and another one that was followed on Thursday before Friday's big drop. So that level is quite strong in terms of resistance, and for as long as we remain below it, the near-term risks are tilted to the downside. Now, for the market to potentially break above the zone in the days or weeks ahead, we do need to see probably a trade agreement with a major trading partner or a major de-escalation in the Middle East conflict. Now, with both the Bank of England and Federal Reserve meetings taking place this week, the pound will be in sharp focus, particularly because we'll also have the inflation data from the UK to consider as well. And ahead of all of those events, we've seen the market come back down a little bit after breaking the support trend of this rising wedge pattern. And so the path of least resistance in the short-term outlook has turned slightly bearish, but key levels of support still remain intact, in particular this level right here, which was the high from last September, a level which was tested on a couple of occasions in April before we finally broke above it in May. That level has since turned into support on a couple of occasions. So as long as we remain above that area, this will keep the long-term bullish traders happy. However, if we do go back below that area of support between 134.34 to 134.70, this shaded gray region basically, if we were to go below that area on a daily closing basis, in that case we will have created the first major bearish reversal pattern on the cable. Now with the pound struggling against the US dollar and indeed against some of the other major currencies because of the weakness in UK data of late, which has raised the prospects of a Bank of England rate cut in August, we could potentially see the likes of the pound yen and other pound crosses weaken as well. Now the pound against the Japanese yen is testing this level of support at 196, which was tested back in March, and again on a couple of occasions in May, and indeed earlier this month, before we finally broke above it yesterday. But it's kind of struggling to hold above that area. So if you were to go back below this area today, then that would be a bearish outcome for the pound yen as well. Looking at the weekly chart, we can see that the currency pair is at a major inflection point really. This level had been support and resistance on a number of occasions in the past as well, and as you can see, it is struggling to break above it. So from a bullish point of view, we do need to see a weekly close above this area to potentially clear the path to 200 plus. That could happen if we potentially see the stock markets recover and we see the de-escalation in the Middle East conflict. Now, for more market updates and insights, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.